Particularly hard hit are the small caps. So are there opportunities for investors here after big falls in values? Not yet, according to Roger Montgomery from Montgomery Asset Management. He joins me now. Roger, welcome back.
Thanks so much, Tiki.
Now, we've got pretty poor business conditions at the moment, largely due to mining, and that's almost 100% because of the downturn in China.
Absolutely, and not only are things slowing down in China, but Fitch, Charlene Chu from Fitch came out just in late June, and I don't know that many people picked up on it. And the point that she made was that we've seen credit growth in China expand, if you take the off-balance sheet items into account as well, at double the rate between 2008 and 2012, at double the rate of GDP growth. And the correct point that she made is this is usually a really good predictor of a full-blown financial crisis. Now, what we have to remember, and I've just had some clients come back, by the way, as an aside, who've just come back from a tour of China, and one of the things that they've noticed is previously we all knew that lots of buildings were being constructed, and we know that the Chinese buy apartments, but they don't rent them out because they want to keep them new. But what's happening now is the buildings are going up, but they're not being sold. There's no transactions, there's no exchanges going on, and the developers are not lowering their prices because they fear that that will be a sign that that prices are going down and people will panic. The point being that China's growth is slowing, and what we've got to remember in Australia, and this is really important for Australian investors, is that all of our growth between 2001 and 2011, all of our growth in the demand of iron ore and coal and oil has been due to China.
Just pick you up one thing, because we had a guest on the show last night, Ken Curtis, out of Hong Kong, who actually was talking very much about when I raised the Fitch report, he was saying, well, actually, that he thought that the Chinese knew about the Fitch report long before it actually came out. They were conscious. They've got rising interest rates now, and they're using monetary policy much more. But he still expects growth to be around 7%.
Well, 7% is people. You've got to remember the analysts were expecting 11% when it was 12, and then it came down to 10, and then they said it would be 9, and it came down to 8, and then they said it would be 7, and who knows, it may finish at 5. But the point is that growth it's been the construction growth and the fixed asset investment in China that's caused the demand in iron ore. Now, that's why we've seen in the Australian market, we've seen the resources sector fall so much.
So now we've had these commodity prices come off. How much in, say, that 10 years around the boom have small resource stocks come off?
Well, what's actually happened is prior to the mining boom that we had, resource companies represented about 10% of the Small Ordinaries Index, small resource companies. That grew to 45% at the peak of the boom. It's halved now. And we've seen the ASX Small Resources Index drop by 50% from its peak. Now, what would happen if the components, the resource component, fell to 10% again of the index? Well, they could halve again. And so a lot of people are saying, I'm getting
because they're not there yet. They're not back to 10% yet.
And what I'm being asked is whether or not there's any value in that sector at the moment. And I think it could get worse before it gets better. A lot worse. And that's just in resources. Outside of resources, we're not seeing any value at all. And that's really interesting. You know, we've seen the index drop about 8% now. But what we're seeing is outside of resources, the healthcare index, for example, hasn't fallen at all. And that's one we're particularly enamoured with, particularly over the next 10 or 15 years.
And you have been for a while, actually, haven't you?
Yeah, absolutely. That hasn't fallen at all. The banks have dropped a little, but not enough. They're not below our estimates of intrinsic value. They're still at slight premiums. And consumer discretionary stocks, only the bad ones have fallen, the good ones have gone up.
And the fact that the Australian dollar is coming down now significantly, is that going to change your view on stocks?
You might remember earlier in the year we talked about how that would benefit companies like Cochlear and CSL and QBE, and it's doing exactly that. And I think we could see the Aussie dollar fall a lot further. And all we need for that to happen, by the way, is for the US to grow a little bit stronger or for China to slow down a little bit more. Both of those things are negative for the Australian dollar, and so those stocks will benefit. But of course, there are some good companies that I think are at the point where investors might want to think about whether or not they talk to their advisors and investigate them a little bit further. But they're off the beaten track, so to speak. They're not the major types of companies that people would normally think about. A company called Corporate Travel Management is one of those. Another one called Silver Chef, which of all things supplies finance for equipment for cafes and restaurants, which during the GFC continued to do really well.
So overall, you think the market is not cheap at the moment?
Not cheap enough to wade back in with your boots on, no.
All right, Roger Montgomery, we enjoyed talking to you. Thank you very much for joining us.
Thank you again, Tikki.